Assalamu alaikum. I am Khadizatuz Zohara welcoming you all my class of risk and uncertainty. Today we are going to learn about the concept of risk and uncertainty. At first we have to know what is risk. Risk is the possibility of actual result to be different from the expected results. So, probabilities of variations between actual return and expected return create the risk. The ups and downs or the volatility of rate of return is also known as risk. The higher the volatility, the higher the risk is, and where there is no volatility, there is no risk. Some examples of risks are: a company was expecting to earn 20% next year but able to earn only 15%. Here, deviation of actual return from expected return is 20% minus 15% is equal to 5%. Here, the risk is 5%. Another example is investing in a project we have earned 5%, 10%, 8% and 15% in last 4 years. Here the returns are not equal in each year. Every year's returns are different. In one year return is 5%, in next year return is 10%. Another year return is 8%. There is ups and downs. This is the volatility and this is the risk. Now we are going to learn about uncertainty. Uncertainty. The term risk arises from uncertainty. The situation or the event which is totally unknown or uncertain is called uncertainty. This is the state of doubt about anything. It cannot be measured and controlled as it is totally unknown or unpredictable. The area of uncertainty is more than the risk. Some examples of uncertainties are: office building of a company is destroyed due to earthquake. Here nobody knew about earthquake and for that reason this loss due to destruction of building is uncertainty. Another example is CEO of a renowned company has died of heart attack. For that the company is facing problem. This situation is totally unpredictable. Nobody knows when who will die. So there is no scope of precaution and this is the uncertainty. Now we can define difference between risk and uncertainty. Though risk arises from uncertainty, but there are some differences between these two concepts. At first, not all uncertainties are risks, but all the risks are uncertainties. Secondly, possibilities of occurring unfavorable events are called risk, where not only unfavorable events, the events which are unknown, either favorable or unfavorable, is called uncertainties. Thirdly, risk can be measured but uncertainty cannot be measured. Fourthly, as risk can be measured, it can be controlled, but uncertainty cannot be measured and it cannot be controlled. Finally, risk can be avoided through different techniques, but uncertainty cannot be avoided. Sources of risk. From different perspective, sources of risks are also different. There are two perspectives of sources of risk: from the perspective of business firms and from the perspective of investors. From the perspective of business firms, there are also two types of risk: business risk and financial risk. From the perspective of investors, there are also two types of risks: interest rate risk and liquidity risk. Now we are going to learn about business risk, financial risk, interest rate risk and liquidity risk properly. Business risk. The risk aroused from the inability to meet organization's operational cost is known as business risk. The organization faces these types of risk More often, who collects capital from only internal sources? If any organization's regular earnings like sales, regular incomes are volatile, then sometimes it may face crisis in meeting their regular expenses like salaries, wages, rents, etc. Then business risk arises. Controlling business risk is tough as they funds through internal sources and there is no external sources. It cannot be avoided. Financial risk. The risk is aroused from financing from external sources. The firm which has high amount of capital collected through loans is more exposed to this financial risk. When a firm is unable to repay its loan or interest of loan, then it is called the firm is facing financial risk. As these types of risk arises from funding from external sources, this can be avoided easily by controlling and avoiding taking loan from external sources. Interest rate risk. The investors who invest in long-term securities like bonds, debentures, shares have to face interest rate risk. When because of volatility of market interest rates, the value of the invested securities decreases. That situation is known as interest rate risk. How much interest rate risk a security has depends on how sensitive its price is to interest rate changes. Investing in short-term securities, these types of risk can be reduced. Liquidity risk. Liquidity risk usually occurs due to the inability to convert a security to cash without a loss of capital. This type of risk generally arises when a business organization or an investor with immediate cash needs holds a valuable security that it cannot sell at market value due to a lack of buyers or due to an inefficient market. These types of risk can be reduced through investing in those securities which has active market. Hope you all will understand. So now there is time to homework. I have given you three questions. You have to write it in your copies and send it in my inbox. Thank you all.